Hello and welcome to today's event. It's nice to see you all, even though it's virtual and we're far apart from each other. I'm Nina Trentman, a bureau chief at the Wall Street Journal, covering corporate finance, including corporate taxes, so international and domestic taxes. I'm based in New York. I understand most of you are based in Europe, so good afternoon to you all and thanks for joining. I started covering the OECD's plans for sweeping changes to the global tax system in 2017 when I was still based in London, specifically looking into Pillar 1, Pillar 2, and then also the digital services taxes that many countries have introduced since then. I relocated to New York in 2019 and have been covering the topic since then. We last week reported on the agreement between US Treasury Secretary Janet Yellen and other G20 finance ministers on a global minimum tax of 15%, and also other changes that are planned as part of the Pillar 1 and Pillar 2 changes that are being discussed on a global level. Many companies that we've spoken to have told us it very much remains to be seen what happens in the end, whether these plans come through or not. And I guess that will be something that we're discussing later as well with some of our panelists. We have about an hour and a half of program with speeches, but also then 2 panel discussions. And I hope that we'll shine some light on some of the questions surrounding those tax proposals, Pillar 1, Pillar 2, the global minimum tax, and also then the digital services taxes in Europe and elsewhere. To get us started, we're going to have a quick welcome speech by Roberto Lischia, the president of Netcom, which represents European digital technology companies and who is hosting today's event. So Roberto, why don't you give us a quick introduction for the event?
Thanks, Nina. Thanks for the introduction. And I'm very pleased that we have been able to organize this event, which is really timely and in tune with the discussion that the G20 leaders are making on the new digital tax. And I'm also very pleased that we have a representative of our organization at European level, Ecommerce Europe, through which we have a discussion also with the Commission authorities. And of course, we have also a representative of the expert of that topics, which is very technical, but which have also a very important impact on our industry. And we will have also industry leader that will discuss that. But I'm also very grateful and pleased to have Dottoressa Fabrizia La Pecorella of the Minister of Finance Italian, which is also in the OECD organization debating and dealing with that topic. So the discussion today is for me very, very important because we have been dealing with that topic since 3 years, I guess, at least at the Netcom level, that, as you are saying, with Ecommerce Europe represent a lot of industries in Europe. Of course, this digital tax is related to the fact that we have a digital economy that need today a new tax model. Because many things have changed. There are a lot of new business model, and the absence of borders in the flow of products and services are putting a question on how we can deal with the taxation of this new way of exchanging goods and services around the globe. If we look to what the European Commission has done in recent years, and the study that they've done, it comes out that the digital company have had in the last years a growth rate which is close to 14%, compared to the 3% of the IT companies and to the 0.2% for the other multinational. So of course, the digital economy needs to be redefined because nowadays, of course, the fiscal policies have to face phenomena of high mobility of both taxpayers and capital. And the high number, as I was saying, of cross-border transactions. I have figures which is incredible about the number of transactions that are flowing around the globe. And of course, this is changing the way of doing business. So the identification of the new tax base for the digital economy have to take into account the fact that the supply of goods and services don't have anymore a physical presence. The e-commerce is making, we have figures that says that 18% of e-commerce in Europe is made by cross-border. So people that are buying in another country. So the boundaries are not anymore there. The dematerialization of the economy constitutes, of course, a significant change, since tax systems in the past were traditionally based on the physical production of goods. So we are now in a new environment. Companies resident in one country are usually taxable in another country in which they make profits. So we have to take into account that the profits are produced but where you are not there, but where you have your consumers and your customers. And there is another point very important, in my view, to think to a new digital taxation. The way in which consumers access to digital services free of charge upon the transfer of their personal data. So there are transactions between consumers and industries that are not economy or money transaction, but they are just based on service, based on exchange of services. So that needs to push to redefine a new model. In the last 20 years, we know that the digital service providers, platform, online intermediaries has changed dramatically. So they have changed their view, their way of doing business. The development of online platform has enabled millions, thousands of small companies to go abroad and to go cross-border. And there is another point very important that we have stressed also at the Ecommerce Europe. The new taxation model has to be not on digital, but has to be on all the models of the new business way of doing business. It's not enough to think to digital, but the distinction between online and offline is rapidly disappearing. If we think that one of the biggest platforms in the world is not a digital platform, but is Walmart, which is a company that is a physical company, but they are now competing in the digital world. So in the digital world, so we don't have to set up a new way of taxing digital, but we have to think to a new way of taxation in general terms. And of course, the OECD published a proposal that we are strongly supporting, that has been put in discussion since October last year, and it has been the proposal has been discussing also in Venice on the 9th of July, and the objective is to have that proposal accepted by most of the countries by the end of the year. And we think that is very important that this proposal find its way to be accepted also by the reluctant countries, because there are some countries that are reluctant. And of course, the Pillar 1 and the Pillar 2 are very important, because as we know, Pillar 1 is very important for the global economy, but also for the new geopolitical relation and accord among countries, because the Pillar 1 says that all the big multinational entities that have a turnover above 20 billion of euro and have a profit which is higher than 10%, between 20 and 30% of the residual profit will be redistributed to the countries where the business is made. And this is very important also to avoid that the European Commission And I hope that the European Commission will stop to set up a new law only for Europe on the digital tax. Because if we find an accord in which 20 or 30% of the residual profit above the 10% is redistributed among the countries where the business is done, that can be a way to avoid to have conflict, a geopolitical conflict among countries. And the second pillar is as important as the first one, because it says that all the consolidated group that have more than 750 billion of turnover in the preceding fiscal year will be taxed with a minimum amount of 15%. And I hope that will also avoid to the countries like France, Italy, and Spain to find a situation in which these new tax laws in these countries will be withdrawn by the national law, because that is another issue that can affect a good global relation among the different countries. So those two pillars are important, both for, let's say, geopolitical relation, but also because I think that it is important to have a law, a fiscal law, which is appreciated and accepted by other countries. Some countries, as we know, are still discussing some unilateral initiative. And I hope this will be strongly stopped. We support that this new way of thinking at the global level could be the only way to find a coordinated reform of the international taxation. And of course, we NetCom and Ecommerce Europe, we encourage the European Commission and the European organization to focus all the efforts for reaching a globally agreed solution based on the OECD proposal, which we believe that this can bring to a new way of relation between the countries, but also create a level playing field both for companies and for countries, because as we know, the digital business will be the real engine that will boost the global economy in the next years. And we have already seen that in the past years. So we need to have a picture, a frame, which is a consolidated frame, which is accepted by countries and companies to concentrate our efforts to the development of the economy on one side and of the services for the citizens and the consumers at the global level. Thanks, Tina.
Thanks, Roberto. We now have Michael Jansen, who is a public affairs advisor for Ecommerce Europe, which represents the European digital service and digital commerce sector, who will give us a short overview over the position of Ecommerce Europe. Michael, the floor is yours.
Yes, thank you very much. And thank you very much for the opportunity for me to speak here on behalf of Ecommerce Europe today. As Roberto already shortly anticipated, we're indeed representing the interest of the European digital commerce sector towards the European institutions. We're based in Brussels, and NetCom is one of our founding members. And I'm actually very happy to speak on this topic today here, because over the last years, months, we've been quite an active stakeholder in Brussels on this topic. And we see that finally now developments are moving quickly. So at global level, at EU level, even at the national level. And I think it's good for me to provide you with some of our key points from Ecommerce Europe's position at this stage. So first of all, I think, as Roberto already mentioned, we are very positive towards the agreement that was reached by the OECD and the G20. As after many years, we're very happy that a global solution has been found. We always have been, and we are still fully supportive of a global solution for the taxation of the economy. And we believe, and we continue to believe, that the OECD is the only venue, and it remains the only venue, to achieve a proper solution for the taxation of the economy. Crucial now is actually for the next steps is for the success of the global solution will be that the Commission, as well as the European countries, as well as the reluctant countries that Roberto already referred to, that they show commitment to uniformly implement the global tax reform, but also to remove the existing digital service taxes and to pause any discussions on potential new national plans. As we're based in Brussels, for us it's of course very important also to follow the European development. And as we all know, next to the global discussions, the European Commission is also planning to present an EU digital levy. Earlier this month, as Ecommerce Europe, we actually expressed our concerns about the European Commission's initial timing for presenting their digital levy plans, because they were actually supposed to come out today. And we argue that proposing an EU digital levy at such a crucial moment of the global negotiations, now that finally an agreement has been found, but still a lot of technical details need to be finalized. So we argue that it could distract from the global talk. So we were very, very pleased that the Commission positively responded to the concerns raised by us, but also of course by many other industry representatives, but also by the US. And that they decided at this stage to really prioritize the global tax reform and to postpone the publication of the EU digital levy to at least October. And we fully agree that successfully concluding the global process will require a strong effort from all the countries involved, from the European Commission. And we think that putting the EU digital levy at hold was a fundamental step to avoid jeopardizing actually the process at global level. However, even with the publication in October, we still have some very significant concerns about the upcoming EU digital levy proposal. So we're also not alone in this. We have heard in the last couple of weeks, months, that the US has also been quite strongly concerned about the EU having a separate digital tax plan. And with that also come for European companies a bit of a risk of potential retaliatory measures in case the EU were to proceed with a separate EU digital levy. And in terms of the content of the upcoming proposal and what we've heard so far from European institutions, from the Commission, we would like to raise a few points about our concerns for the proposal. First is what Roberto already mentioned, is that we're a very strongly believer that any new tax rule should not ring-fence the digital economy. I think the last year in particular shown that digitalization is becoming a more and more crucial element of also offline business models. And with an accelerated development also of omni-channel businesses, it's becoming more and more complicated to distinguish what is digital from what is not digital. That's also why we think a modern taxation framework should not focus only on digital and should treat businesses equally, regardless of their business model or their distribution channel. And we understand that the European Commission has been given an assignment to design an instrument to raise funds for their recovery plans. However, we think that especially now, digitalization is something to be encouraged and not something to be discouraged through a separate tax or levy. Furthermore, we believe, and it's very unfortunate because what we hear is that it's going in a different direction. We believe that any change to the tax framework should be based on profits and not on revenues. Taxes based on revenues can have a regressive effect on startups, on scale-up companies, which often invest a lot and often operate at a loss in their growth phase, but also for companies that operate in a very low margin environment, such as retail, what we represent. So in particular for these plans for revenue-based taxes, it can be expected, well, the target may be companies that are much larger. We expect that in especially low margin sectors, these companies will likely pass on the tax burden to business users or to even consumers. And then, although we would, of course, fully support a global solution and would really discourage any separate EU digital levy, if it were to come, we really stress that the European Commission should ensure that any EU proposal ensures full complementarity with the global agreed tax. And they should make sure that any company, that no company should face double or even multiple taxation. And finally, we think that any introduction of an EU tax, of a separate tax at EU level, should always be easily enforceable, also towards non-EU based actors. And we stress this more often because this is necessary to avoid putting them at a competitive and unfair advantage towards EU-based businesses. So that's a bit of an overview of the position of Ecommerce Europe. So thank you very much for your attention. And if you have any questions, please feel free to reach out to us afterwards.
Thank you, Maaike. I appreciate it. Hopefully we can come back to some of those points that you raised sort of during the panel sessions that we now have. Yeah, now we get a bit deeper into the woods with our first panel. We have Paolo, Frederic, and Luis, who work for tax advisory firm Taxant in Italy, France, and Spain, and they'll share a bit in terms of how the situation is in their countries. Paolo, why don't you start us off with telling us a little more about how the digital service tax has been implemented in Italy. What are the main features and also what are the issues? And then we can sort of go to Frederic and Luis as well.
Sure. We have introduced this year the digital service tax. In principle, the digital service tax comes from the EU proposal, but it is however slightly different. In principle, the taxable entity are taxable entity that at a worldwide level have more than 70 and 50 million revenue at the group level. It's important to say that in Italy, the revenues are not related to digital services, but are related to revenue of all kind, while the second threshold that we see, the 5.5 million euro, these are the second threshold is related to the revenue comes from the digital services. In principle, the taxable services are the one as mentioned in the directive, so the targeted advertisement, the availability of multi-sided digital interface, plus the intermediation in supplies of goods or services. It's important to know that also it's excluded any revenue deriving from the direct sale on internet. As far as the targeted advertising, it's important to know that in Italy, for example, each operator that is involved in advertising in the supply chain is subject to digital tax for the consideration they receive. So for in Italy, for example, in the targeted advertisement, we can have a cascade effect where multiple transactions are taxed that comes under the DST. As far as we already know that as far as the sourcing method, this is a very tricky point because we rely on where the user is located, and in order to know where the user is located, in principle, the law provides that the IP address is the one of the point that you can rely on, but there are also other methods, variable alternative methods. This method could be, for example, GPS, geolocated the devices, or could be also different method that, for example, based on any knowledge that the company may have that can be relied on where the devices is used. I think that is also important because it impacts on how the source of the revenues are considered, if located in Italy or not. If the intercompany transactions, for example, are excluded, the taxable base is not a taxable base related to each transaction, but in principle, it's a worldwide ratio. In principle, you multiply the revenues of each entity for a ratio that combines the transactions that are related to the Italian territory compared to the whole amount of transactions that the company performs. Very important is to say that according to the Italian tax authority in the circular letter, they say that the DST qualifies as indirect taxes, of course, otherwise it would be incompatible with the treaty. Then it's important to know also that in principle, the Italian tax authority is expected to have for 2020 700 million of revenue from the DST, but in the end it turns out that only 230 million was the revenue, and this revenue comes from 49 taxpayers. So this is a little bit of background of the Italian DST.
Thank you. Frederic, how's that in France?
Well, in France, the digital service tax was implemented in 2019, so a bit earlier than in other European countries. That was really a political stand not to wait for a confirmation by the European Commission and also way to try to speed up the negotiation at the OECD level. So the question was really to answer the challenges raised by the existence of revenue stemming from local users without necessarily a physical presence. And French DST applies only as in the other countries, as in Spain and in Italy, to group of companies of which revenues are higher than 550 million euros on a worldwide basis. Also, the presence in France has to exceed 25 million euros of qualified revenues, so that's a bit higher than in other countries, and so that means that the number of groups concerned by this digital tax in France is probably lower than in other situations as in Spain or in Italy. So similar to the DST created in other jurisdictions, France focuses on 4 kinds of digital services and exclusively on these services. That is marketplaces, multi-sided interface services where users interact among them, advertising targeting, and data collection. So as for example, streaming services or distance sales operated by a company on its own via internet are excluded from the scope of the French digital service tax. I think it's important to keep that in mind, because when we will turn to some explanation on Pillar 1, we will see that the scope is much broader than the scope of a digital service tax. So French DST is assessed on an allocation of worldwide revenues, more precisely on the proportion of annual worldwide cash-in based on several allocation keys to determine the percentage of so-called French presence. As an example, French presence on the marketplace will be computed by determining the ratio of sales involving at least a vendor or a buyer located in France. It is very obvious that this is not so easy to make this kind of computation. And this basis is then applied to a tax which is a 3% levy, irrespective of any profitability criteria. That's why we are talking of an indirect tax as opposed to a direct tax. A fair estimate of how many groups are concerned in France would be in the area of 40 groups. And in terms of tax revenues, French tax authorities announced 350 million euros for 2019. We don't have yet the figures for 2020.
Thank you. Yeah, Luis, how is the situation in Spain? Do we also have different rules there all over again? It sounds as if there's some inconsistency between the rules, at least in Italy and in France, what we heard so far.
Indeed, yes. Thank you, Nina, and thank you, Netcom, for the invitation to be in this panel today. No, yes, sure. I mean, actually, in Spain, we do have the Spanish digital service tax, which actually will be paid for the first time during this month of July, despite the law was enacted in October 2020. The reason why the actual payment of the tax has been delayed was because basically nobody knew how this would work in Spain, and there have been long discussions and detailed discussions between tax administration and taxpayers in the last few months, fortunately, and those discussions resulted in some guidelines and some publications by the Spanish tax agency trying to clarify some of these concerns. But let me go back a little bit, because I believe that it's important to understand the context where this digital service tax comes. And basically, let me share with you my view that the digital service tax is due to a social claim by the people in the streets that large multinationals should be paying their fair share of tax. And actually, my view is that should the US tax reform had taken place 10 years ago, probably we will not be talking today about Pillar 1, Pillar 2, and so on, because the US technology companies, digital companies, would be paying their taxes in the US. So basically, this led to a social claim of the people in the streets. Actually, there were demonstrations asking for large multinationals to pay their fair share of tax, and this was taken to basically to the programs of political parties that promised that they would start collecting taxes from digital companies. And actually, in Spain, you can refer to the digital service tax as digital service tax or as Google tax. That is, I mean, actually, if you look at the newspapers, they will not talk about digital service tax, they will talk about Google tax. So it's very clear to which group of companies this digital service tax was targeting. And actually, I believe that that all this discussion, and then we can get a little bit further in this discussion, but actually, we are saying that this is a discussion about the new parameters or the new ways of international taxation because of the new mobility and so on. Well, I believe that is actually a discussion between countries of residence of the large multinationals and market jurisdictions. And the market jurisdictions wanted to have their share in this very nice stake, and they have managed to get it. Now everybody agrees that market jurisdictions will get a share. And how these market jurisdictions are getting a share? Well, through this digital service tax. And this is why Spain implemented and approved this digital service tax, which is interesting because it's constructed as an indirect tax. But actually, it is constructed as a temporary measure until Pillar 1 is implemented, which will be taxing profit. So difficult to understand how you replace a tax on profit with a temporary measure as an indirect tax. So this raises a number of concerns. But getting to the point about the differences of the Spanish digital tax and the others, the Spanish digital tax is inspired in a draft directive on a digital tax at the European level, and I believe that also the French and the Italian ones are inspired in that directive, but unfortunately they are only inspired, but they are not homogeneous taxes. So taxpayers are doing big efforts to comply with the Italian tax, which are useless to comply with the Spanish tax because there are big differences in the way they are implemented. So basically, the concern in Spain is that despite, I mean, the basic features of the tax, and the threshold, it applies to groups above 750 million of revenues with 3 million euros in Spain. But the concern is that taxpayers are making huge efforts to properly comply with this tax. The tax authorities are making huge efforts to be able to audit this tax. Actually, for me, it's difficult to see that the Spanish tax agency will devote many resources to audit such a complex tax with the expectations of revenues that they have. By the way, the Spanish tax administration and the Spanish government announced that their estimate in October 2020 was to collect above 900 million euros of digital service tax. However, that was in October 2020. And since then, they have held many discussions with taxpayers to properly understand which transactions will be subject to a tax. So I guess that they will need to remake new estimates now that they have a more clear idea of where they are going to collect taxes from. So this is somehow the Spanish landscape. As you can see, it's not a peaceful landscape these days.
Thank you. Yeah, I think we'll get back to that point that you raised a little later. There was actually one question that I have for you, Frederic, with regards to Pillar 1 and Pillar 2. It seems to me as if those go well beyond taxing the digital economy, which is what we heard earlier, I think also from Roberto. Can you explain, just to get us all on the same page, basically the main characteristics of Pillar 1 and Pillar 2?
Yeah, sure. Thank you, Nina. I will try to give you in a nutshell the differences between Pillar 1 and Pillar 2. And basically, Pillar 1 and Pillar 2 answer two different topics. Pillar 2 is the most well-known part of the global agreement reached by the OECD and the other countries, because I think it's important to mention that we are not simply talking of the OECD, but the inclusive tax network, which includes other countries than the OECD countries. So one of the main features of Pillar 2 is that it creates for a group of companies of which annual revenues are higher than 750 million euros. That's always this topical amount. It creates a minimum threshold of direct taxation, which has to be computed on a jurisdiction by jurisdiction basis, and that's the very well-known minimum threshold of 15% of effective tax rate. The so-called income inclusion rule, IIR, does not seem to imply that each jurisdiction has to apply this minimum tax. It merely creates a minimum standard commitment for a parent company located in another state to tax the difference between the 15% and the effective local tax rate when it's lower. And obviously, USDT rules as well as existing CFC rules may still apply. So that's really a minimum standard rather than a general compulsory rule. A striking point is that, as I just mentioned, Pillar 2 application is not at all restricted to a digital economy. It may be applied to most of the activities. So as such, Pillar 2 is one of the achievements of the global base erosion project rather than a digital focused measure. As opposed to Pillar 2, Pillar 1 can be qualified as the answer given by an inclusive tax framework to the digitalization of the economy. One of the main features of Pillar 1 is that it creates a right to tax in the country where the user of the service is deemed to be established, that is the market country. And this is based on the new nexus concept. So with Pillar 1, the idea is not to struggle against low taxation in certain countries, it's rather to displace the states where large M&A will be taxed. So that's rather a question of allocation of right to tax among states. Of course, to the extent that Pillar 1 would be implemented from 2023 as currently foreseen, the question on whether local VST that we just discussed could be maintained or not is a crucial question. It's a key question. That said, main feature of Pillar 1 differ dramatically from the current DST as we just discussed. First of all, the new right to tax under Pillar 1 would apply to a group of companies with worldwide revenues this time exceeding 20 billion, I'm saying billion, euros. So we are by far above the 750 million threshold, which applies in most cases for the local DST on a worldwide basis. Second, Pillar 1 is conceived as a right to tax locally a residual profit beyond a normative margin of 10%. It is thus not an indirect tax, and it has to do with a deep reshaping of transfer pricing principles. Third, also tighter in terms of group of companies concerned, Pillar 1 is larger in terms of transactions which may be concerned. It is not restricted to the 4 digital services depicted earlier. It may concern any kind of sale on a local market where there is a limited physical presence of the sellers. And even if it is not something which is in the current status of what was announced early in July, it is noticeable that in the 2020 report on Pillar 1 issued by the OECD, 2 categories of activities were mentioned for Pillar 1. On the one hand, automated digital services, which mostly concern the digital economy, and on the other hand, consumer-facing businesses, which is, of course, by far larger. So I stop there.
Thank you. Yeah, it sounds as if, well, it is a very complex topic and it has many subtleties. One other thing that we wanted to discuss or explain before we come to more questions. Paolo, can you explain to us the difference between amount A and amount B in the Pillar 1 project, which is also an important part of the proposal?
Yeah, sure, because still, let's say, the July release, there is this two amount A, amount B that refers to Pillar 1. As already said, Pillar 1 is a profit that has to be taxed by the, let's call the market jurisdiction country. It should be a residual profit that has to be computed, as already Frederick said, about 10% in excess of the profit, and part of this excess profit, amount 20% and 30% should go to the market jurisdiction. In principle, the idea is to depart from the international taxation that has been so far. In principle, international taxation, as far as business profit is concerned, has always relied on the concept of permanent establishment, and permanent establishment is that, let's say, business can be taxed in a country where I have a physical presence there. Never a country can tax when there are only sales there. But with amount A, we depart from this crucial concept, although, let's say, that in this very new word, the P concept still remains, because we have amount A that goes with market jurisdiction without maybe a physical presence, but still we remain with the P concept. So even more, I would say, complexity. The problem that I see with amount A is that the amount A, rather than the Pillar 2, are not additional revenue at the global level. It's just a redistribution of revenue, because there are some countries that may tax, but there are other countries in principle that have to surrender their taxation. And so the OECD says that if we look at this 10% and more than 20 billion of group level, there are 100 billion of revenues, but this 100 billion of revenue that goes to the market jurisdiction have to be surrendered, and we do not know who will be surrendered this. And this is a very interesting point in order to avoid double taxation, because it's very different amount with the Pillar 1 from Pillar 2. So I think that here there will be major problem. And also on the so far we have listened that it's important that all the companies are on an equal footing, so there should be no distinction among digital taxation and non-digital taxation. So for me, it's interesting because, as already Frederick said, it's in the detail that you can make distinction. For example, how you allocate the revenue source for the market jurisdiction, if you take the same approach for all kinds of business, because I remember that in the work so far at the OECD level, when we look at how the source income in different market jurisdictions have to be allocated, there are still the world is divided among the automated digital services and the consumer-facing business. So also this kind, how you allocate the profit, is you use the same rule worldwide, or you still try to make a distinction among the digital company and all. So this is for me also very important. So amount A is the new, let's say, it's the new international taxation. It's a way forward to new rules. Amount B, let's say, is try to simplify the old rules, and in principle goes with the TP rules. We know that TP rules are very difficult to apply in some cases, especially where there are intangible assets. The amount B refers in principle try to create a standardized manner where let's say predetermined benchmark are to apply for the baseline marketing and distribution activities in order to simplify this always changing work. It's very difficult to apply taxation. So amount B try to simplify the TP rules. In principle, it applies only for let's say distribution arrangements where routing level of functionality, there are no ownership of intangible and no non-bid risk. It's interesting also in this case to see how if the OECD will take the same approach, because in the work so far, amount B has been considered as mandatory, so it's not an option, it's not been intended as a safe harbor or to be applied on optional level, but is intended to be remunerated on, let's say, on a strict basis. So every country should apply amount B, cannot be refused to apply it. So also the amount B, it's interesting to see if, considering always that there are developing countries, developed countries, if this amount B will be applied at all level, or any distinction will be made also at this level. This is more or less the features of amount A and B.
Thank you. Luis, can you explain to us again, sort of, we heard about amount A from Paolo just a minute ago, and you mentioned the digital services taxes earlier. Sort of, can you explain a little more sort of how amount A and those national digital service taxes will interact, and also sort of if those taxes would be repealed, if so, under which timeline, and also how that works with the European digital services tax, the EU-wide one that Micah mentioned earlier, which I think, well, work has been paused until October, but it is, of course, still something that's sort of, at least at the moment, it's not been abandoned, the project, but it's just paused.
Indeed. No, I'll try to explain whether this is compatible, incompatible, or how we see it. Now, let's see what we have now. What we have now are local digital service taxes that have been implemented by European jurisdictions, in principle as a temporary measure. Now, these digital service taxes are impacting on groups with revenues of 750 million euros. And now these digital service taxes in the local legislations either have a sunset clause. I don't remember whether it was Italy or France, the one that included specifically a sunset clause, so that the law said, well, when there is an agreement at an OECD level on Pillar 1, the tax will disappear. And then, for instance, in Spain, we don't have it in the law, but we have it in the preamble, that is in the introduction to the law, where the purpose of the law is explained. They clearly say, well, this is a temporary measure until there is a global agreement at an OECD level on Pillar 1 and on how international taxes should be levied. But now, the agreement on Pillar 1 is that Pillar 1 and amount A in Pillar 1 will apply to groups with revenues about 20 billion euro, as Frederick very clearly remarked, 20 billion. 20 billion euro is much larger than 750 million euro. So we are comparing, as we say in Spain, pears and apple. I don't know why you say that in England as well, but we are comparing different animals here. So would the fact that Pillar 1 will be implemented mean that Spain, France, Italy, UK will be ready to say, okay, we cancel our local taxes after making such a big effort to put the systems in place to collect it, to put the systems in place to audit them? I'm skeptical about that, and we'll see. But it's also true that in these negotiations, and Pillar 1 has been a clear negotiation between the countries of residence, the US mainly, and the market jurisdictions. And my understanding is that the position of the US administration was very clear. We go ahead with Pillar 1, but you forget about the local taxes damaging our companies. Well, let's see how it goes. But really, technically speaking, they are not necessarily incompatible. Also, because the local taxes, the digital service taxes, have been constructed, I believe, that artificially and on purpose as indirect taxes in order to be compatible with tax treaties. And Pillar 1 is clearly a direct tax. So what will be the end? Really, we don't know. And to this, we add, or the European Union has added, an additional complexity, which is the European Union digital levy. Now, actually, the first question is this European digital levy intended to be compatible with local digital service taxes? Because Let me try to explain this. The digital service taxes are a financial resource for the Spanish administration, for the French administration, and for the Italian administration. The European Union digital levy is intended to be a financial resource for the European Union. And then, okay, then probably it will be allocated among, but so really there is a first question on the table, which is, well, will the European Union digital levy be compatible with the local digital service taxes? I would expect that as soon as there is a digital levy at the European Union level, the local taxes will be removed, but there is no warranty there. Now, also, if you hear to the European Union representatives, and for sure, as all of you know, the European Commission made an announcement on the taxation of the new century and so on a few weeks ago. They said there that they need to think of a digital levy that is compatible with Pillar 1. Well, really, I mean, I believe that this is ready for negotiation. So really, I believe that digital service taxes will be here for a long time. That is my, I don't have the crystal ball, but if I would need to read that, I would say that they are here for long. Also because, again, I mean, administrations and taxpayers have made huge efforts to make this possible. And we'll see when whether Pillar 1 will be actually implemented. Also, something that is important is these are political agreements, but then you need to implement this technically and in the local legislation. That is, you need to go country by country, parliament by parliament, having them accepting that that they agree with this. And now, I have just one comment on the US. That is, at the end of the day, this Pillar 1 is about mainly the US sharing part of their tax collection capacity with the market jurisdiction. As of today, with today's rules, these big companies with headquarters in the US would be paying taxes in the US. And now with Pillar 1, the US says, okay, we're going to share with the market jurisdictions some of our tax collections. Now, will the US Senate be happy to sign this? We have had experience in the past where the US Senate blocked some tax agreements concluded by the US for a decade because they had some concerns about the exchange of information of US citizens. So if there are these big concerns about exchange of information of US citizens for tax purposes, I would say that maybe there are some concerns about sharing a nice part of the cake with the market jurisdiction. So let's see how it goes, but really it's difficult to have the crystal ball and see whether the local service taxes will disappear. I would say that they should.
Yeah, I guess, well, very much remains to be seen. And I guess, of course, the concern, I think, at least also here in the US, we've had a lot of coverage and commentary around people saying, well, US Congress, specifically the Senate, is one of the big hurdles that this needs to pass. Of course, including then also the national parliaments that you mentioned in all the other member states. I was just curious to hear sort of from Paolo and Frederick also, and maybe you, Luis, sort of, what are you hearing from corporates that you're hearing, sort of the companies that you advise on a day-to-day basis in terms of their tax structures, tax planning? Do you sort of, what are the concerns that you're hearing from corporates?
I think globally, corporate, they don't like uncertainty. So they like, to some extent, I would not say they don't care on the rules to the extent that they are stable, they care, but it's more important to have stable rules than uncertainty. So I have heard some of my clients saying, okay, we can agree with any kind of new system, but we don't want discrepancies among the various countries. We want something systematic. We want something where there is no room for challenges made by the tax authorities because the rule would be unclear, and that's one of the topics of these national digital taxes. As mentioned earlier, that the basis is very difficult to assess. So probably most of the companies they like more the concept of Pillar 1. Also, it's very complex than the concept of digital tax. for various reasons, because it concerns less companies, of course, but also because there seems to be a general consensus as opposed to the digital service tax.
Yeah, actually, Nina, I mean, we see how taxpayers, and mainly large multinationals, make huge efforts to properly comply with their tax obligations. I mean, it's already in their ADN. I mean, it's they do want to be tax compliant, and as Frederick mentioned, what they do appreciate is having clear rules. You would be surprised of the efforts that the digital companies that are affected by the Spanish digital service tax, the efforts, the resources that they are devoting to clarify questions when they could have taken the position of, okay, this is an unclear tax, let's try to comply with it more or less, and probably the tax agency in Spain will have difficulties to audit it. No way. They are devoting huge efforts, or the usual suspects, huge efforts to properly comply with the rules. So we do not anticipate any kind of funny movement, not at all, in order to avoid the new rules. Rather the opposite. They are really working together with the tax administration to create clear rules. And actually, I believe that we intermediaries, and now we are officially called intermediaries because of a directive in the European Union about the obligatory reporting of tax aggressive schemes, we act as intermediaries, trying to explain the tax administration how the multinationals work, what their targets are, and explaining as well multinationals how the tax administration work. And I believe that we have an important role trying to bring together or bring closer both parties. But really, we don't expect any kind of movement trying to circumvent the new rules. Rather the opposite. Yes, they are working hard to have these new rules a reality and to be able to properly comply with them.
If I can make just one small remark, is that for sure there is the complexity. What I heard from the companies, from the corporation, is that even in this world, the tax authority, for example, in DST fields among Italy, France, and Spain, could have collaborated more in order to, let's say, exchange some knowledge and information. Because at the end of the day, we can say that they are pretty the same. However, also with the circular letter that they issued, the guidelines are different. So also in this case, even though we have a common base, but the fact that the tax authorities does not talk with each other make a level of complexity higher and higher. So I would expect it, let's say that in such a case also the tax authority may speak a little bit among them if they have a common base or a common knowledge of the meaning of some words that are still there in the Italian, French, Spanish law. So this is something that also for La Pecorella, for example, even though they are national system, a little bit more effort, informal among the tax authority can help big multinational to handle all this ST. Otherwise, it's really, really difficult.
Well, thank you very much for taking the time and for walking us through some of the issues around the digital services taxes, Pillar 1 and Pillar 2. You basically prepared the ground well for our second panel, the industry roundtable, where we'll have Diego joining us from Google Italia, where he's responsible for public policy. And we also have Laura joining from Vodafone, who's serving as head of tax. Yeah, welcome both. Thanks for joining. Appreciate you both being here. Laura, why don't you kick us off, sort of explaining a little bit how Vodafone deals with the digital service taxes in Europe. We heard earlier from the previous panel that there's differences between, for example, Italy, Spain, and France in terms of how they're implementing these taxes. How does your company navigate all these differences between the rules?
Sure, thank you, Nina. So as Vodafone, as a group, we have been monitoring very closely the development and the enaction of digital service tax as local measures. We have some countries that have been faster than Italy. but the approach we used was actually the same in all our markets. We have been trying to work very closely to the preparatory works of the enactment law, speaking with the tax authorities, because of course we are a telco, we are also a digital company, because now here is mainly about the digitalization of economy, and the telco is absolutely providing digital services as well. So what we wanted to achieve in working closely with the tax authorities, to try to make the tax authorities aware that our sector is really, despite being digital, it's very much local, because we are very much regulated and we have infrastructure that are local. So, and actually our data, the data analytics that we provide as a service, they are generated from SIM, which is does not fall within the definition of digital platform. So basically, what we did as Vodafone is try to make them aware that our sector should not be impacted. And this has been successful not in all markets. For example, in Italy, the interaction we had with the tax authority was very, very good. We have been meeting them and explaining what we do and why we should not be impacted. And in the end, this was reflected in the guidelines. While, for example, in Turkey, the DST is completely different, and of course we are impacted. So what we see, where we are indeed in the scope of the digital service tax, is what you have already and my colleagues have already mentioned, the true complexity of managing such a weird type of tax, because it may be simple to the eyes of the tax authority that we simply have to compute the DST and pay, but instead a new tax like a DST requires a lot of effort, investment, not only in the IT system that needs to be adapted to collect a new process of data in order to calculate the new taxes, but time and effort of people. So just to give you an example, when in Italy we were discussing to change the VAT rate of 0.5%, this was an investment of millions for us and 8 months of work. So can you imagine if you have to set up an entirely new process and an entirely new setup of system to track the DST services in scope? For us, this was a really, and for our CFOs, this was really something that they had to bear in mind for their budget and in order to monitor the target of their KPI. So, and of course, being digital service taxes or local measures, there is nothing that you can do in leveraging on economy of scale, because each and every tax has different features. So this is our approach. So very glad that at least in Italy we had a very good interaction with tax authorities, and they understood that our sector is, despite being digital, does not cross the borders in terms of revenues and so.
Yeah, it sounds like just a lot of implementation work, especially given that it's at the moment different national service taxes, as you said. So there's no economies of scale where sort of if you implement it for one country, you could do it the same in another country. It sounds, given that there's some differences between different rules, that you at the moment at least you can't do that.
And if I can just add one bite to this, you have also to think that at least in Vodafone, we are used to think about business cases. So if there is a sunset clause and the DST remains in place for 5 years, a CFO the rationale of CFO will be, okay, and shall I make this investment so huge if I know that there is a time frame of 5 years and no payback?
Yeah, that's actually a good point. That's something that we often hear, like when we talk to CFOs or tax chiefs, for anything that is not really long term. Of course, there's this question as to how much do you allocate towards it, and sort of how much do you put in terms of resources. Diego, how has that been at Google? Sort of how has the company navigated the digital services tax in Italy and also maybe in other European countries? If you can talk a little bit about that.
Well, we pay it. It's super easy because as our Spanish colleague was stating before, in some countries it's even called the Google tax. So there was no conversation on whether we were affected or not. It was very clear from the beginning. I will get back to the point in 1 minute, but let me emphasize equal LoRa. Even if we are paying, and we were in target, we have had very positive collaboration with the Italian revenue agencies, and the Italian revenue agencies has resolved some of the issues that were raised in the previous presentations, in particular on double taxation. The circular letter of the Italian tax agencies, I think, is the only one, for sure, in the 3 countries represented that directly addresses the issue of the risk of double taxation for online advertising. That, as you know, has a very long chain, and there was a concrete risk that the same piece of advertising was taxed more than once along the chain every time that it was sell from one subject to the other. But apart from this, let me very briefly comment on what was stated before, because Italy was also the first country in which digital service taxes were proposed. The parliament approved the first one in 2013. Then it was repealed, and then we had a lot of debates about this. So, but this debate, that it's almost 10 years old now, is based on 3 assumptions. And 2 of the 3 assumptions are simply false. So let me please reiterate this because it's super important. The first one, the true one, is the tax system is not fit to respond to the issues and the organization of the global economy as it is now. And this is something that we agree and all companies agree, and that's the very reason why the OECD has kicked off the inclusive framework process some years ago. The 2 fake assumptions that are always repeated, but they still are fake, are that one, the digital economy is a sector of the economy that works differently from other sectors of the economy. It has been widely demonstrated that the digital economy is the economy. Basically, every company has some kind of digital services or of digital interfaces, and it will be even more in the future. So we need a tax system that is fit for the digital age, not special rule for a so defined sector of the economy. And the third one, and the one that I'm more committed in this within, the third first fake assumption is that so-called digital companies pay less taxes than traditional companies. That is completely untrue. Google, for example, pays on average at global level 20% of effective tax rate. That is aligned with the OECD average. That is above some traditional companies' effective tax rates, and it's below some other companies' effective tax rate. And interesting, there are digital companies that pay less than us, and there are traditional non-digital companies that pay less than us. So there is an issue, that is how we allocate tax money from multinational in the diverse jurisdictions. There is another issue, that is tax avoidance, that some companies could do, and there is big discussion about this, but there is not a specific issue of digital companies paying less taxes than others. And so, specifically on DSTs. DSTs are taxes on revenues. It has been already highlighted by the previous speakers. And the natural effect of taxes not on profit but on gross revenues is crystal clear and transparent. In the end, they are paid by users and consumers. Back to your question about how Google is implementing this, how we are reacting already in France and in Spain. We have added regulatory operational costs in the invoices that we send to our customers. Yes, I remember correctly. I recall 2% both in France and Spain. So in the end, our advertising services cost more, and part of these costs are inevitably covered by customers. What is a possible solution? It's the global framework that we have just discussed, and I'm quite surprised and interested that now there is an open debate on whether this framework would drive to a repealment of digital services taxes, because digital service taxes was exactly created because there wasn't an agreement on a global framework. So it would be natural and normal that they will repeat as soon as the global framework and the global deal is defined. So somebody was mentioning it. Italy has an automatic sunset clause in the position. So I expect that as soon as the agreement is in place, the Italian DST is repealed. And that kind of deal, and an international deal, is the only way in which we can assure, on one side, tax equity and a level playing field among the companies. I repeat, we pay 20% of effective tax rate. That is perfectly aligned with the OECD average and is above the agreement that has been finalized under Pillar 2. And second, and that's the last point I want to make, but the most important one, taxation should be a tool to boost innovation. Europe is devoting billions to the recovery funds, to the digitization of the economy. It's quite interesting that on one side we subsidize the digitization of the economy, and on the other side we could keep a specific tax that in the end is a tax on innovation itself.
Is there, in terms of, given that it's still very much depending on sort of whether the global framework goes through, whether it's being implemented or not, whether then the national digital services taxes are being repealed or not, like, of course, it seems to me as if this is still very much a phase of discussion, and it's very difficult to see what the finite outcome will be. Are there any sort of, in terms of your companies and your business models, have there been already any changes as to what is based in which country, how you're billing, sort of in terms of sort of licensing agreements? Have there been any changes with regards to that because of or in response of those potential tax changes that will come with the global framework? Or is it basically just that you're dealing with the national digital service taxes now? You, Diego, said, for example, we're paying more, or you're paying. Or is there, sort of just wondering in terms of like how your business is organized in Italy, for example, if there's been any structural changes yet, or whether it's mostly that you're waiting to see how this global framework.
Thank you, Nina. This is a super interesting question because the answer is no and yes. So there is no change in our business model as an effect of digital services taxes. We are keeping operating as we used to do. But interesting, in Italy, we had changed the way we operated as an effect of a tax case that we had in the past. And so we had already changed our business model in Italy. In Italy, we, for a subset of customers, we bill directly from Italy, not from Ireland. And this was something that had happened before the DSTs were approved. So once again, to reiterate the fact that in the end, often these are the answer to a not existing problem or a problem that is different from the solution that has been implemented to address it.
How about you, Laura? How about Vodafone? Have you made sort of any operational changes yet in response to those tax changes, or is it mostly still the sort of just complying with the tax rules, but with the existing model and setup that you had before?
No, we haven't really done any changes yet. We are very much closely monitoring the development at the OECD level. I'm positive by nature, so but even if I'm very positive that the OECD will that in October we will get to an agreement on the framework, and the OECD will be working on the following 12 months, I guess, on drafting the guidance. and proposal on Pillar 1, Pillar 2. I do not expect that the sunset clause, for example, in Italy on DST will be activated before 3 or 4 years, unfortunately. So we haven't done any structural changes, and for the way we are organized, I do not think that even if Pillar 1, Pillar 2 comes into action, we will be changing our structure. Also because by culture, Vodafone has not been really considering the tax driver as a key driver for shaping the business. Also because of the sector, as I was saying, the sector is very much regulated, so we do not really have flexibility. So, so this is the first reason why I do not think that we will be very much impacted. And the second reason why I believe that in general the companies will not be really re-onshoring processes or organization or units is because for sure the Pillar 1, Pillar 2 shall create this level playing field. But I think that there will be other features of a tax system that will be relevant to attract investment. And for example, if I think about Italy, it's not because of Pillar 1 or Pillar 2 that all of a sudden we will become the most appealing countries, because we have other issues. So, for example, we need to implement a tax reform on justice, because in Italy, if you want to litigate a case, it takes from 10 to 15 years. So my feeling is that if we indeed get to an agreement on Pillar 1 and Pillar 2, still there are some other features of any tax system that will become more relevant and will still play a role to attract investment inbound. So, we will have cleaned the path for having a war on tax rates, but in the end, we will have other features that we need to fix in general, because the corporation, multinational corporation, what they look for, apart from tax rate, that I think is no longer for many multinational the driver, no? It's not really the time any longer for having aggressive tax planning, tax haven, at least many of the multinationals have been working with. The true driver for relocating and attracting investment are an efficient tax system, meaning a tax system where you can have frank and clear and close cooperation with the tax authority. And I speak about cooperation because for me, cooperation with the tax authority is the way to collaborate. So first of all, the opportunity for taxpayer to have a good relation with the tax authority, a simple and clear tax rule set, which is not all, for example, the case here in Italy, and the tax justice that is efficient. So these are the other three drivers that I think will become more relevant if indeed we can succeed in Pillar 1 and Pillar 2. And this will be the one reshaping mostly the investment. At least, for example, if you want to decide where you want to set up the group procurement unit, this is what we will be looking for, not a tax rate that is very low. It's efficiency and certainty of rules.
Yeah, that sounds like the perfect transition to our next speaker, who is Fabrizia La Pecorella, who is the Director General of Finance of the Italian Ministry of Economy and Finance, who's going to share some thoughts on sort of the process and the progress, hopefully going forward, and also might address some of those points that you just raised. Thank you very much both for joining. I appreciate you taking the time today.
Thank you, Nina.
Yeah,
Nina, good afternoon.
For joining. Good afternoon. Good to see you again. Yeah, we've had an interesting afternoon so far, hearing lots of different sort of viewpoints. We learned about, well, Pillar 2, Pillar 1, the digital services taxes. It sounded to me, and I know of course that it is, but it sounds to me as if there's a lot of work waiting for you involved in the process, as well as others that are working to bring these changes to the global tax landscape. I was just wondering, sort of, with you taking on this position of chair of the OECD's Committee of Fiscal Affairs in January, if you could explain a little bit your role in progressing this global tax framework in the coming months, and also how that's going to change once you take on your new role in January.
Well, as you say, I mean, I will start as the chair of the CFA in January. And, you know, the next 6 months, unfortunately, will be full of work. So before getting there, I think there is a lot we have to do for completing the agreement that was achieved by the inclusive framework and endorsed by the G20 finance ministers in Venice last week. And I mean, I will be unfortunately or fortunately very much involved in that as the president, as a G20 presidency. So to be to basically what we have achieved in Venice is an agreement on the key elements of the 2 pillars of the international tax reforms. And there are a number of key issues that have been defined. So there is no further work to be done. But to complete the framework for implementation of the new rules, there are still decisions to be taken. The goal is to agree the framework for implementation in October, and to have the ministers endorsing an implementation plan, that is a timeline for the implementation of the new rule. With respect to this, I would say that, I mean, here we are in a context of very down-to-earth tax experts, and I've heard somebody talking about 3, 4, 5 years, you know, as a reasonable time to have the new rules operational. I should say that finance ministers have different perspectives, and they were so enthusiastic about the agreement reached in Venice that they were unanimously, you know, sharing the belief that the new rules can be implemented by 2023. Which would mean for me next year an incredible amount of work for ensuring that the model rules for implementing Pillar 2 are finalized and endorsed at the level of the inclusive framework, and that the MLI, a multilateral convention implementing that is needed to implement Pillar 1, can be finalized and open for signatures already next year. So realistically, I should say this is basically what they expect. Realistically, a lot of work has been done already. I mean, we should never forget that we have agreed the key elements of the new rules last week, but I mean, last week was at the end of a process that lasted at least 4 years. And we should not forget that the new, the discussion that has led to the agreement is in part an entirely new discussion, because the United States started the new discussion last February, I should say, at the first G20 finance ministers by withdrawing their position on the safe harbor implementation of the new international tax rules, and by proposing a new approach for the definition of the scope of Pillar 1. This is the comprehensive approach that has been explained before. that attracts into the scope of the new rules the largest and most profitable multinationals. And by doing that, basically, and that approach implies that Pillar 1 will be applied by nearly 100 large corporations, very large corporations. And this means in turn that it will be a lot easier to implement, the new rules will be a lot easier to implement, and the new rules will be a lot easier to administer for tax administration. So, I mean, you know, it is very ambitious. It's not totally unrealistic for Pillar 1. So for Pillar 1, there is a lot of work to be done entirely, but on new basis. And in principle, it is possible to do it. For Pillar 2, the technical work is a lot more advanced. The model rules have been discussed at length in the technical working parties at the OECD, and reasonably, they could be finalized by the end of this year. So, so basically, the timeline here is that in October, we will have, before the finance ministers meeting, another meeting of the inclusive framework. And at that meeting, we expect that the remaining issues that are still open in the definition of the new rules can be agreed by the 132 members that have already joined the international agreement, and hopefully by the whole membership. So hopefully we could have on board the remaining 7 countries and jurisdictions that have not joined yet the international agreement. Then after that, we will have mid-October a finance ministers and central governors meeting in Washington, where they could endorse the new rules. Technical work will continue. The model rules for Pillar 2 can be finalized by the end of the year, and the work for the multilateral conventions can start to be finalized next year. And building on the experience of the multilateral instruments that was defined and open for signature at the end of the BEPS project could be immediately open to signatures. Obviously, as somebody was pointing at before, I mean, I think it was Louis was recalling, I mean, was pointing at the fact that I mean, a multilateral convention to needs ratification by national parliaments, that this process can be complex, not only in the United States, but also in other domestic, in other state countries and states. And, but certainly there will be, I suppose, a strong and a strong push for all the countries that have joined this agreement and that will sign the multilateral instrument to do that quickly, because there is, I mean, the citizens' expectation with respect to these new rules are so high that I think that politically, you know, there will be a much stronger support this time also with respect to the ratification of the multilateral instruments that we put in place for the BEPS. So this is what I expect for the incoming, for the remaining part of this year and for next year. And well, maybe 2023 is just much too much, but I expect that implementation of the new international tax architecture will be quick.
You said that there are still a few things left to decide between now and then, sort of in terms of the implementation plan, but also sort of you were mentioning that there's been agreement that has been reached on many issues, but that there's still some outstanding questions sort of what are the key points sort of in terms of what still need to be decided from your perspective, and sort of how difficult is it to achieve an agreement on that?
Well, let me certainly one very important element related to the previous discussion with Bert, that we would need to settle by October is the definition of the required coordination between the moment in which the new rules will be applied and the moment in which the existing unilateral measures like DSTs and other similar relevant similar measures will be withdrawn. We would need to define that. This implies that we will need to agree on what are the unilateral measures beyond the DSTs that are already explicitly mentioned in the G7, have been explicitly mentioned to start with in the G7 Finance Ministers communique, and then again in the agreement endorsed by the G20 Finance Ministers. So the DSTs are obviously, there, and they will obviously be, withdrawn at the right moment. But we would also need to better define what unilateral measures can be, what are the features that unilateral measures need to have to be compatible with Pillar 1. And there is no discussion that there can be unilateral measures that can be compatible with Pillar 1. I mean, it is clear that to be compatible with Pillar 1, they would need not to be discriminatory, and they would need not to impact on the objective of Pillar 1. And as it was recalled pretty well before, I mean, the objective of Pillar 1 does not establish new rules for taxation, but Pillar 1 does reallocate taxing rights on residual profits of very large multinational corporations. And this basically means that agreeing on that is an agreement on the extent of the reallocation of profits that has been agreed as compatible with the new global international order. And everything that will impact with that will be incompatible. But certainly there can be unilateral measures that can be absolutely, can very well live a parallel life, with together with Pillar 1. The reason why, despite the fact that the scope of Pillar 1 includes this group of nearly 100 multinational corporations, whereas the scope of the domestic DSTs obviously is completely different. I mean, it includes only businesses operating in the digital sector, and it also includes businesses that are smaller in size. Does not is an observation that is not relevant for discussing the coexistence of the two things. I mean, the important what the 132 countries that have signed the agreement at the inclusive framework think we can achieve with these rules is a new international tax architecture that is stable and that provides multinational corporations or businesses operating cross-border with tax certainty, and that can reallocate the residual profit, without without creating, without leaving any space for double taxation. And this is conceptually incompatible with domestic DSTs that we know have been introduced in domestic in the domestic legislation of the countries that have introduced them, just as a political response to the lack of an international agreement on the taxation of the profits of multinational corporations, and that was deemed by, I think, certainly by Italy, but I think for most governments that have introduced it, as a necessary political response, being perfectly aware that was a suboptimal response, that the DSTs designed in the way in which they are designed to give rise to double taxation, to create situations in which there can be tax disputes and do not contribute to what multinational companies need to have to operate efficiently cross-border and contribute to the good functioning of the global economy. So basically, you know, it is not. I mean, it is obvious that they will be withdrawn, and they will be withdrawn completely. There is no point, you know, in thinking of keeping these domestic measures in place to apply them to the companies that are out of scope of Pillar 1. It wouldn't make any sense, because it would undermine, you know, their existence would undermine the stability of the new international tax architecture that is one of the primary objectives that governments have been trying to achieve with this agreement.
There's actually one thing I wanted to ask you. You mentioned the multilateral instrument earlier that was used to implement the BEPS project, the on base erosion and profit shifting. Are there any learnings from how BEPS was implemented in terms of how then, if there was an agreement on this international framework, how that could be implemented across different countries? Because I find it fascinating that in the end, there has to be this international agreement, but then every of those 132 countries that you mentioned have to go to their own parliament and have it signed off in one way or the other, which of course, depending on the legal system of the country, can be easier or can be more difficult. So just wondering if there's sort of any learnings from how BEPS was implemented that one can take to make sure that this international framework goes through, or if not, maybe not. I don't know.
I mean, what we learned is that it's difficult. That is a process that needs to be followed very closely at a domestic level. The hope this time is that the political pressure on national parliaments for ratifying can be very strong. You know, because I mean, you know, the request for responding to the tax challenges of the globalization and the digitalization of the economy were so strong, and now, I mean, this could help in pushing national parliaments for ratification. But as you say, there is very little to learn. I mean, there is only the full awareness of how difficult that is when it gets to the parliamentary processes.
Do you have any sort of, just wondering, given that we heard several times how important it is that the US Senate is in support of this, just wondering if you've got any message for the senators in the American Senate who will be voting on these, as well as other parliamentarians. We are approaching, or next year, there's going to be midterm elections here in the US. And of course, well, we're all aware that things can change in terms of majority in Congress. And just wondering sort of how far you see that also as a potential impediment.
No, I see that as a potential. I mean, I see, you know, the timing of the process as a potential help. I mean, if we work like crazy, we are committed to, and I would say that everybody around the table, I mean, is really committed to do this. If we work like crazy and we get the work done on the writing of the multilateral conventions quickly enough, you know, I mean, I think we all know that it's important at least to try and have the thing ratified, you know, by the US Congress before the midterm election next year. So that is a challenging deadline, but is also a very strong and important incentive.
Yeah, I think, well, you wrapped it up well by saying it's going to be a lot of work. Well, I appreciate you taking the time today to join us, as I do for all the other panelists and speakers that we had for today's event. I think we're unfortunately out of time, and I'm receiving little signals that I'm supposed to wrap this up. Yeah, I appreciate you all taking the time. I hope that some of the questions around Pillar 1, Pillar 2, the global minimum tax, digital service taxes have been answered in today's webinar, and would recommend to stay tuned. I think Netcom will be hosting future events, and I think Taxland will as well. So stay tuned, and thank you very much for joining today.